Welcome to the Art of Money podcast with Art McPherson.
And thanks for checking out the Art of Money podcast. My name is Mark Owens alongside Art McPherson and Luke McCarty. All the information for the McPherson Financial Group, you can find it at theartofmoneyradio.com. Let's get to it because a lot of the conversation continues to be about a recession, inflation. Those are the words of the day. But when you listen to the financial talking heads, it's really hard to figure out if we're at the beginning, the middle, the end of this recession. Where are we?
Credit card usage skyrocketing and at record highs, savings rates plunging, over 30 trillion of global wealth has evaporated.
We're only about a quarter of the way down in this economic slowdown domestically and internationally.
Look, I've been very vocal about this. I'm very rarely this bearish, but this setup is one of the worst I've seen in my career.
Consensus seems to believe right now that there's less than a 50% chance of a recession.
We don't think leading indicators of the economy are going to bottom out until late next year.
It's 100% certainty that you're in recession now.
All this noise, Art McPherson, Luke McCarty. When you talk to a client, how do you help shut down some of that noise when they want to talk about the recession?
Yeah, there's definitely a lot of noise out there. You know, we sent out a video through YouTube to our clients a couple weeks ago, kind of detailing, the first half of the year and kind of what's happened. And we also talked about how, inflation may have peaked in the month of June. So our last inflationary print was 9.1 on the CPI. If that is the high, the markets could rally from here. The Federal Reserve could slow down, and, that's positive for the stock markets. But when you look at things, it is very, very bearish, right? Everybody's negative, whether it's inflation, whether it's the Federal Reserve, whether it's the Russia-Ukraine situation. I mean, everything's down. And typically when everything is this far down, you're pretty close to a bottom, usually.
Mm-hmm. Yeah, you can never really know when the bottom is, so that's why it's hard to tell. However, the indicators, the market has already priced a lot of this stuff in. The market has been looking at this for a while, and that's why we're kind of where we're at. What we don't know is, how slowed the economy gets. Right now we're on the front edge of that. We technically have had 2 negative quarters of GDP, so we are in a technical recession, but that doesn't mean it feels like a recession. So you've just had 2 negative quarters of growth, domestic products slowing down. But now you're starting to feel people are starting to check their spending. We had gas hit $4.55 a gallon there for a while. It's come off those highs, which has helped a little bit. Then we had interest rates accelerate from 3% in December of last year to 5.8 to 6.2. You want to talk about putting the brakes on refinancing and mortgages? Mm-hmm. That is a big one right there. So you had interest rates go up over 100%, and you had gas up almost 100% there for a while. So that really put the brakes on a lot of spending and a lot of extra spending and a lot of projects. And you could have a couple, trying to buy their very first home in December, and they're going, okay, when it gets summer and the kids are out of school, let's move. We already got our house picked out. We already know what we want. We've got our money ready and saved. And all of a sudden, when they went to look at the financing, it jumped $800 a month, and now this house that they're ready to buy is out of their price range again. So you got a lot of that going on right now. So a lot has changed just since May. So that's actually a good thing when it comes to inflation, because we should start seeing inflation come back off its highs. However, it's a bad thing when you start talking about the economy.
772-281-5223. Just seems like there's a lot of noise out there, but it's always good to get it in perspective. And that's why that initial consultation from the team at the McPherson Financial Group is no cost, no obligation to you. Give the team a call. Let's sit down. Let's begin putting that plan together. Again, 772-281-5223, and always online at artofmoneyradio.com.
So speaking to, the economy, the recession, things being very bad news and very negative, here's a history lesson for you guys.
Okay.
So as of June 30th, right, the first 6 months of the year, right, SPY, which is the S&P 500, is down about 21%. At the same time, another ETF, LQD, which is the bond market, is down about 17%. In the history of the United States of America since 1788, how many times has the stock market and the bond market both been down more than 15%?
So stocks and bonds both down 15%.
In the first 6 months of any year.
First 6 months.
Don't Google it.
I'm not.
Why are you trying to act smart? Just answer it.
No, I'm thinking. Carry the 6, divide by 7. I'm going to say never.
Arthur?
I'd say twice.
The answer is never. Yes. In 234 years, this has never happened. And think of all the bad events we have gone through, right? Wars, earthquakes, presidential assassinations, right? Plagues, riots, you name it. This has never happened. So the first 6 months of this year is historically bad. And historically, when this happens, the last half of the year is positive. So even though this piece has never happened where they're both negative, when just the S&P 500 is down 15% or more, the last half of the year, the last 5 times just the S&P has happened like that, it's been positive.
Okay, well, break that down for me. If I'm a pre-retiree, I'm in that retirement red zone, I'm maybe a couple of years into my retirement, what does this mean for my bottom line? Do I need to just sit tight and watch, or do I need to make a move?
It depends what you've done during, right? If you've rode the wave and, you've been down 20 or 30% in stocks, 15 to 20 in bonds, now's probably not the time to sell. If you sold earlier in the year, now's a great buying opportunity. If you have cash on the sideline, now's a good time to buy. If you have a taxable account where you have capital gains associated with it, now is a tremendous time to sell, take the loss on paper, buy something else, especially in the bond market. Your municipal bonds are down for the year. So everything you have that could have been a hedge against risk is probably negative for the year. It's time to take a paper loss and look at some tax loss harvesting.
And how does a paper loss help an investor, Luke?
It lets you offset capital gains tax in the future. That could be capital gains tax from the stock market, the bond market, a real estate property, anything you have that is taxed at the capital gains rate. These losses that you have now on your statements, if you sell, right, the worry is you're selling and you're capturing a loss. You never really want to do that. I'm not advising that. I'm saying sell, buy something else that moves in the same direction of what you owned prior.
And one thing you have to keep in mind too, you can't have a wash sale. So you can't buy something that's the same security back, or the government will not allow you to count that as a loss. But you can buy something in the same sector. So you can buy a security that's another bond fund, but it's not the exact same bond fund you were in before. That would capture the loss at this point, and you could ride it back up. Even if we go back to zero, Mark, and you look at bonds for the year in 2022 and it did 0%. So you're like, wow, that was horrible. They're still up 12, 13, 14, 15% from where we are today. So you ride the way back up, but then you're able to capture the loss during the year. And then you have that paper loss. Even if you can't use it this year, you can carry it forward. So you can carry forward it. And maybe next year, if we have a lot of gains, you can use it against those gains.
Are you seeing that from people, Luke? Are you having people saying because of what's happening with the stocks and the bonds, like it's really had a negative effect on their purchasing power?
What we are seeing, I can tell you this, my name's not Luke, but what we are seeing is we have had a ton of clients have positions where the last 2 or 3 years, they were not able to move because they were heavy in something. Maybe it was a stock from a corporation. Maybe it was S&P fund, where it was just up and up and up. And we've had such corrections, the capital gains that were just crushing them a year ago, all of a sudden become viable and available again. So we could do some reallocations, do some repositioning in cash accounts and accounts that normally our clients would get hit very hard with, because we've got some great programs where we do tax harvesting. So the program itself captures losses even in up markets. So we want to get them in those type of programs. So sometimes though, we have to wait because the positions they're in are not a good time to sell. So we're taking advantage of some of those opportunities now.
Art McPherson, you brought it up in the last segment talking about the Fed continuing to raise interest rates to try to get inflation under control. And I want you to hear this clip from economist Mohamed El-Iran. He tells Bloomberg that all of these interest rate hikes, well, it's not over yet.
They're not just reacting, they are catching up. And that's why they simply cannot wait. I worry that on the way there, they may break something, and then you get the stop-go phenomenon that would be the worst possible outcome for this economy. We need to get inflation out of the system. We should have taken even more advantage last year of the strong economy, but we still need to take advantage of a strong labor market to get that done. Because otherwise, we will have both an inflation problem and a growth problem next year.
So we talked about that, the inflation problem, but what about these interest rate hikes? What does that mean to our retirement plan?
Yeah, I agree with what he's saying. I mean, the Fed is way behind the curve. They've been holding interest rates at a 0% level for 10 years. And that's why they put $9 trillion of debt, on their balance sheet as an asset, right? The government uses that as an asset, even though it's a debt. Wish we could do that. So they're way behind the curve. Historically, during high inflationary times, the federal funds rate has to get above the CPI rate in order to get inflation down. That would mean the Fed needs to go up about 8% more. So that means your federal funds rate about 9.5% to fight the inflation, the CPI of 9.1. I think we're in a little bit different times now, and I think we're willing to live with a little bit higher inflation for a few more years. The whole transitory talk, anything the Fed has said recently over the last several years has been wrong. So I'm not trying to predict things either, but the bond market is predicting that the Fed will stop raising rates by the end of the year and potentially cut rates next year. So we're looking at federal funds rate by the end of the year this year at 3.5%. And the Fed believes they can keep raising rates next year, but I think we'll be further into a potential recession and growth will slow too much. The Fed will slow down. History has told us they like low rates. They don't want to do what they have to do. So I think we're going to have, higher inflation for the next 3 or 4 years. So time to buy an I bond, right? They're going to be there.
Well, the one advantage we have as a consumer is the Fed can't afford 10% inflation because they are paying the interest on the national debt at that rate instead of at 2%, 3%. So they definitely want lower inflation rates so they don't have to get really high expenses, because if they get that rate up there on the Fed funds and they get in the 4s, the 5s, the 6s, the 7s, the 8s, the 9s, then they're paying that on the debt. So they have a tremendous incentive to get that under control. The reason we have inflation is you have an economy that's hot. You have an economy that's growing too quickly. Well, that has begun to change. So as the economy slows down, and we're already in a technical recession, as that begins to gain more momentum and speed, we've already seen some of the reports out there of jobs being laid off or jobs not being offered. So we're seeing the economy begin to slow. That means that we're going to see the other indicators come in and start to back up this. So there should be less pressure for the Fed to raise over time because of kind of the dynamics that are already working through. We had some weird things this time. We had supply chain interruptions that are still here. Mm-hmm. We had all of the kind of everybody go on vacation at the same time from COVID. We all were stir crazy and had cabin fever. All that's kind of out of the system now. So especially in the states like Texas and Florida, where we've been open and free to run. Even in Georgia, you guys have been pretty free. You were locked down a little bit longer, but the states that have been open for business, those are the ones that have had good recoveries. In our states, people are tired of wearing masks all the time, and they're tired of being locked down. So people are ready to go out there and do things. But we really have great unemployment right now. So we do have the underpinnings of an economy that can kind of rebound pretty quickly as long as the Fed doesn't mess it up.
Let me ask you that. You were talking about the lockdowns, and we're still coming out of like the COVID and people losing their job and how it affected the economy. You're starting to hear it again. I know out in California, LA has issued another mask mandate. They're telling kids in schools in San Diego County they have to wear masks to school again. Even here in Atlanta, north of Atlanta in Gwinnett County, they're saying the school system, kids got to wear masks again. Is that starting to be a concern in the financial industry? Are we starting to get worried about what are they going to do about if numbers keep spiking with COVID?
Not yet, because those have been some of the most restrictive states anyways. Those states tend to be a lot more restrictive than Florida, Texas, and a lot of our conservative areas. So you've got about half the country. I don't think we'll ever lock down again unless there's something really, really bad. But this bounce back of COVID that we have had, basically it's kind of like a head cold. It wasn't really, really bad. It was nothing like the Omicron version of it. So I've had both types of COVID. The first COVID was nasty. The second one was not a big deal. So if they're locking down for that would be not very wise, because I would call it a normal cold. But we'll see. We'll see what happens. But no, the markets haven't been nervous about that yet.
Yeah. Well, it is an election year, so we got to figure out some way. So there's a little
Are you getting a little political with that? There's a little political motivation.
I'm just saying. I mean, I noticed a lot of the states that are going back into lockdown tend to be a little blue. I'm just throwing it out there.
Little monkeypox.
Did you see the World Health Organization now officially declared monkeypox a national health crisis? So.
And by the way, wearing a mask will not help you with that.
772-281-5223. How's the economic downturn going to affect your bottom line? What adjustments need to be made? Give Art McPherson a call. Let's begin that conversation. Let's put that plan together. Again, that initial consultation, no cost, no obligation to you. And Luke, you mentioned it because I know somebody heard it and they're going to say, wait, buy an I-bond? What is an I-bond? Why should I buy one? So Luke, tell me again, what is an I-bond and how do I take advantage of it?
Sure, an I-bond, you have to buy directly through the U.S. Treasury, so treasurydirect.gov, G-O-V, and you can put in $10,000 per year per Social Security number, and right now it's paying about 9.6%. So your guaranteed rate is on a 6-month basis, so it's about 4.8% for the next 6 months. It will change 6 months from now, but given our thoughts on inflation being here longer than expected, you're going to have a pretty good rate on something that's as guaranteed as the government printing money and giving it to you. So you can make about $900 on $10,000 I-bond per year. But when inflation slows down, the I-bond's not necessarily where you want to be long term, but I think it's a good play for the next couple of years.
How long do they have to keep their money there?
So you have to keep it there for 1 year. Cannot get it out for 1 year. If you take it out in the first 5 years, you lose the last 3 months of interest, because it is technically a 30-year bond. Do not hold it for 30 years. If inflation's this high for 30 years, the dollar's not worth anything anyway.
We got bigger problems.
Yes.
But it's worth noting, too, that the team at the McPherson Financial Group, they can't buy the I-bond for you. That's not a product that they offer. However, what they can do is they can help it become part of a full-service plan as well. They can make it part of your entire portfolio, the I-bond. So if you have a question about it, give the team a call, 772-281-5223.
Thanks for listening. Want more from Art McPherson of McPherson Financial Group? Find us online at artofmoneyradio.com. We are an independent financial services firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Securities offered through World Equity Group, Inc., member FINRA and SIPC, a registered investment advisor. Investment advisory services offered through ProStatus Group, LLC. McPherson Financial Group and ProStatus Group, LLC are separate entities and are not owned or controlled by World Equity Group, Inc. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Investment financial professionals are not licensed in all 50 states. Art McPherson is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstances. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Arthur McPherson. Florida Insurance License number A174725.
Today's show has been a work of art.